We looked at economics from a macro view. We went down into a micro view. We went back up to a macro view. Let's stay a little bit with the macro view. In the last video, we talked about things like inflation. Before that, we talked unemployment and the business cycle. Well, when we go through bad times, where there's high inflation or high unemployment, or a recession, people require action. People want something to get done. Somebody has to fix it, and typically that is the government. And there's two ways in which the government does affect the economy. One is called monetary policy. Monetary policy comes from the idea that we're regulating the money supply. How much money is in the system? And that's where the word monetary comes from. Every country that has a currency has a central bank. Now, in the United States, our central bank is called the Fed, or the Federal Reserve, Federal Reserve Board. In Europe, it's called the European Central Bank. It manages the currency of the money supply of euros. There's the Bank of Japan for the yen. There's the People's Bank of China. All currencies have a central bank. And the role is a couple things. One of their roles is to regulate the banking industry. But what they also do is control the money supply of the U.S. So the Fed is the central bank. Banks, if they need money, borrow money from the Federal Reserve. If they've got extra money, they put it in the Federal Reserve. And one of the major ways that the Fed controls the money supply is they set short-term interest rates. So the rate at which banks borrow from the Fed and then loan out the money. So what can the Fed do? Well, the Fed can try to increase the money supply. Why would it do that? Well, it probably wants to stimulate the economy. It may sound crazy, but it may want to stimulate inflation too. If inflation is real low, that means businesses aren't able to raise prices. Typically, the problem is much greater in the sense that it's stimulating the economy is what people, or the Fed, is worried about. We get into a problem because of a pandemic or a recession, and we want to get businesses and people going. We want to get the economy going. We call it easing the money supply. We make more money out, give more money out there. Principal way of doing that is lowering short-term interest rates. People will borrow money. If I borrow money, I'll build onto my restaurant. If I borrow money, I'll buy a car. If I borrow money, I'll buy a house. All of that stimulates the economy. It also tends, because having more money out there, we learned, will also cause inflation. Well, the Fed may want to decrease the money supply. Why? Maybe the economy is going too strong. Typically, though, it wants to lower inflation. Inflation is real high. There's just way too much money out there being spent. So it will do what we call tighten the money supply, and it does it by raising interest rates. Interest rates go up, people borrow less money. People don't remodel the kitchen. People don't buy a car. People don't buy a refrigerator and a washer and a dryer. All those go down. It slows down the economy, and it'll also lower inflation. So that's the Federal Reserve. There are other things in the Fed, but of course in money and banking is probably more important to get into some of those actions. All right, so we're talking about monetary policy. Another way to do it, the government gets engaged, is in what we call fiscal policy. Fiscal policy is handled by Congress. Congress basically either taxes you or spends the money. That's how it can manage the amount of money in the economy. If it increases taxes, the economy is going to slow down. If it lowers taxes, it boosts up. So in 2020, we lowered taxes. 2019, we lowered taxes and the economy went gangbusters. Really went gangbusters. Unemployment went down, GDP went up, everything went well when we lowered taxes. Well, the pandemic hits in 2020. What do? How do we get the economy going? Well, the government can spend money. If the government spends money on things, it can give away money, as it did in 2020, but it can also do projects. I can build roads, I can build dams, I can build parks. If I spend money, I get more money out of the economy. People are unemployed, and the economy goes up. So we're not doing well. We want to stimulate the economy. We should lower taxes, spend money. When inflation is high, we want to take money out. You might want to spend less. Government never does that, so that's kind of worthless to even think about. Fiscal policy is very slow moving. Here's the key: Congress. To get Congress to agree to something, terrible, awful. A lot of things got to get involved. The advantage of having something like the Federal Reserve, it's a smaller group, it's not political, and they act more quickly. In the recession of 2008, there were a lot of things that the Congress could have done. It didn't do any of these. The only people in town with the big boy pants on was the Federal Reserve. So they could stimulate the economy by lowering taxes, increasing spending, or you never really hear about Congress doing this. Why? Because they want to get reelected. So they're never really interested in saying, I'm going to contract the economy. National debt. So we spend more than we bring in taxes. We have what's called a budget deficit. We spend more money than we bring in. I don't know when the last time the United States had a budget surplus. We probably have had at some point, but typically the government spends more money than it makes. And how does it make up the difference? Well, it has to borrow it. If we spend more than we make, we have to borrow it, you and me, so does the government. And here's some amount of money about how much we've actually spent. You can go to the U.S. debt clock at this link and see how much money the government actually owns. If we wanted to get rid of the entire government debt, it would mean that we'd have to pay over $175,000 for every single taxpayer to get rid of the national debt. It's kind of bonkers. And the problem is, at some point, this money has got to get repaid.